Good morning, everybody. I think it's time we start. I don't want to waste any of your time, and I want to take the opportunity to thank every one of you that logged in. So we hope we're going to have a nice session today talking about risk and risk assessment. Sorry?
Is the camera on?
Yes, my camera's on. Sorry, I've just got Fatima questioning me. She's just keeping her finger on my pulse to make sure that everybody can hear and see me perfectly. Guys, we will give you opportunity to ask questions at the end, or in the meanwhile, if there's something very critical that you need to have a little bit more or know a little bit more about, please feel free on the Teams just to click on the and raise a hand so that we can see who it is, and then we'll give you an opportunity to ask the question. Everybody okay with that? I hope you're going to enjoy the session. Let's start by rocking and rolling. All right, risk assessment. What a critical part of a business, because sale is a sale and it's very nice to sell, but if you sell to a risky business, how are you going to make sure that you are going to be paid right from the beginning? Is it necessary to have a credit policy that's going to guide all this? Is it necessary to have a credit application to guide all this and to control all of this? What are the securities that you can call for, and is it necessary to call for securities? I'm going to try and cramp all of that information into a 1-hour session. That is information that most probably I can lecture you on for 6 months, but we're going to do it in 1 hour. And hopefully, by the end of this hour, if you have any questions, we'll be here. Inoxica will be here. You can call me at any point in time, and we will give you the advice or information. Just a little bit of background so that you know from where I come. I've been in credit for 40 years. I've done everything that you can imagine in credit. Credit insurance, credit information, credit management. I've managed ledgers over 3-4 billion rand. I've managed credit departments with more than 100 staff in. I've been in the credit industry. I understand credit. It is in my blood. Risk is what I do. So that's just a little bit about me. If you want to read more about me, you're more than welcome to go into my LinkedIn profile and go and see who I am and what I do. Risk. Very important for a business to ensure that you have a credit policy that guides the way you assess risk. In that credit policy, there will be levels of authority, people with different power, people with different authority levels, people that can open accounts on different levels, people who understand what the risk connotated to that specific debtor will be, and what it is going to be necessary and how to mitigate and manage your risk. In that policy, you will dictate when you have a new account what the process will be. The policy will dictate, will you need a credit application or a service level agreement or both? And in those agreements, how do they talk to one another, and what will be the terms and conditions of these different documents? Terms and conditions being, will I charge interest on an overdue account? Will I use reservation of ownership, which means the product belongs to me until fully paid for? Will there be jurisdiction control? All these terms and conditions, some of them will be very pertaining to your industry and your business, and then you'll have general terms and conditions which pertains to law and guiding and protecting your business. Like, for instance, the clause that says, I will be using a credit bureau to get information on you. I will be sharing my information with the credit bureau as well as to how you as my new debtor will perform with me. And this is how we're going to rule and run this business. So all of this is controlled by what you put into your credit policy and how you manage from your credit policy. So now you've created this credit policy with all its terms and conditions in. If that is not enforced and managed from your C-suite down, it's not going to be worth anything. Some of you had sat in with me on that discussion that I've already had. So a credit policy is a very prominent document. Now we come to the credit application document. Beautiful document, filled in wishy-washy, not signed. How much does it mean? 0. Document needs to be completed in full. and signed. Because if you don't sign that document, if that debtor doesn't sign it, you do not have the authority to do a credit investigation on that debtor. You may not speak to a credit bureau and say, what do you guys think of Martin Petzer Pty Limited? You can get statutory information, which is public information on me, yes. But any credit information will not be given to you because you do not have the right to do so. You must have my consent as your new debtor. So therefore, that credit application starts playing a very critical role in your engagement with the client. A service level agreement is usually just drafted around the services that's going to be rendered to the client. What is going to be rendered? How is it going to be rendered? How frequent is it going to be rendered? Who's responsible for what? What is the risk? Who carries the risk? Who's liable for what risk? Who's going to do transport if there's product to be delivered? Those kind of things. Very rarely does a service level agreement speak to your financial liabilities and things that are contained in that. So it is critical that you have your credit application and service level agreement in one document or very closely working related to one another, but not contradicting one another and not in place of one another. So if you have a clause in your credit application document saying that this is how it will be ruled and it will not be replaced by anything else unless so agreed in writing. So if there's any clause in there and there's a contradictory clause maybe in a service level agreement, it will not replace your credit application until such a time as you and your debtor agree in writing that you will no longer be abiding by this specific clause. Very important in your credit application to make sure that the clauses and rules that you've put in there are, first of all, going to be adhered to and enforced. If you say you're going to charge interest, it's not necessary to charge interest. But if you do want to charge interest, the clause needs to be agreed to upfront. You can't just tomorrow decide you're now going to start charging interest because the guy hasn't paid you and he didn't agree to it upfront. It must be an agreement upfront. Personal surety, if you include a personal surety in your credit application, make sure that you make the debtor aware of it on the front of the document. Say, this is a credit application and a personal surety document, if it's just a clause. If it's not a surety document, that they complete and sign separately. Because you're going to go to court and they're going to say, we didn't know it contained a personal surety. So your risk immediately escalates by implementing a credit application document that is wrongly populated and wrongly designed. So make sure that your credit policy, your credit application, and your service level agreement all talk to one another and are all enforced correctly, because all of that is part of mitigating and controlling the risk in your business. Very important that it is driven from the top down and it is enforced, that no one can break those rules. There must be something against someone that breaks those rules. It must be in your policies that says, if you break the credit policy by doing anything outside this policy, this is what's going to happen to you. I'll give you a very clear example. In the businesses that I worked for, if a credit controller applied cash to an account without a remittance advice from the debtor or an advice in writing from the client saying, take this cash overpayment credit note and apply it against these invoices, you would have been dismissed in my employment. I can assure you of that. Because what do? They clean the debtor's ledger from the back to make it look all nice and clean. They make their KPIs. You give them a bonus. The client comes back and says, oi, 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 what are you doing here? I never paid this invoice. Now you've got to undo all of that, and now you've got a claim against you, and now you can't prove it because all the documents has now been packed away and it's in storage and it's lost, and you're creating a huge whip for your own butt. So make sure that in your policy you have rules and regulations that guides your activity in your credit control department, in your financial department, in your business, and so does your credit application. It controls the engagement with your data, it controls the rules of your data, it controls how you engage with your data. And if they change any of those rules and draw a line through it, and they sign next to it, if it's not acceptable by yourselves, then say so and don't engage. Don't break your own rules, because if someone starts making changes to your terms and conditions, there is intent behind it. They either know that they're not going to pay you in 30 days, and that's why they're not agreeing to certain terms and conditions. And if they say they're paying you in 30 days, make sure that they can abide to that. All right. So now you understand a little bit around what you need, why it needs to be there, and why you need to enforce and institute that. Credit policy, credit application, don't engage unless you have that document completed in full and signed. If you can automate it, and I don't want to sell you Inoxico, please don't misunderstand me, but we do have a product called Fabric, which is an automated credit application document. It's populated with most of the information before it gets to your data. Your data completes the document. You can enforce some of those parts. So in other words, if they haven't completed it in full, they can't go to the next part. The signature is an automated process. They get an OTP number, they accept the OTP number, then the document is signed. And it is all stored electronically, so your whole document is safely guarded with any attachments that you want attached to it in the cloud. So very nicely, you don't have to have hundreds and hundreds of filing cabinets with all these documents in it. It's all stored in the cloud for you. Very nice. So if you look at engaging in that way, electronically, speak to someone that can assist you engaging in that in the correct way. Your terms and conditions, your credit application is utilized for that purpose. So now we've done all of that. Now you start doing your risk assessment. Your new client comes to you. Your credit policy says you use Credit Bureau A for your information. The client comes, signs, fills in your credit application document, and it lands on the desk of your person that is controlling that process. First things first, check that the document has been completed in full. Check that the person that has signed the credit application has got the right to sign the application. If not, send it back. Because if they are not a director of the business, then you need a board resolution, which means the board of directors has said Martin Petzer can engage in any contract with any other business on behalf of this company, on behalf of Inoxico. Let's use Inoxico as an example. So if you don't have that, it's going to mean that that is a fraudulent transaction. So when it comes to payment, that company is going to come and say, hey, we didn't give Martin Petzer authority to act on our behalf. So you've engaged with him and you have supplied product to him, which he had no right to buy from you. So now you've got a problem. So that's problem number one. Problem number two is, if Martin Petzer is engaged with you and Inoxico has started paying you, there's a little bit of proof that the intent was there and that they're happy with the agreement, even though Martin Petzer didn't have the authority. But it could be a laborious process should they stop paying you. So please always make sure that your contractual agreements are signed by the correct authorized people. So now the credit application is signed, it's filled in its totality, there's no terms and conditions drawn a line through, they've signed and agreed, and the credit application lies in front of you. Now, what does your credit policy dictate when it comes to obtaining information from a credit bureau? What do you seem or deem to be indated information? Credit information from a credit bureau, certain of that information is always up to date. What is that information? All right, your information that is always up to date is the information that comes from SAPC. That is your company registration information. Your company name, your auditor's information, your registered address, all that information, always up to date. And of course, depending on your bureau, there'll be all adverse information, whether it was judgments, because judgments are obtained from the courts, and they are constantly updated onto this account. Yet there's certain information that is not always up to date, and you need to establish what do you see information too old to make a risk assessment on. Is it 6 months? Is it 3 months? Now during COVID, of course, with the fluctuation of businesses being in business or out of business, there's a lot of things that can happen. Right now, and I'm just talking a little bit about it, adverse information, especially court information, is problematic. Why am I saying this? Because Sub-C is so far behind in their administration and the courts are so far behind, the court date could not yet have been set, so a judgment could not yet have been taken against Martin Petzer. So there is huge adverse information lying around there in the marketplace, which could not be reflected yet on a bureau's information that you might not know about and that could be critical to you. So the closer that you are in contact with trade references and your debtor himself, with other words, knowing where they are, being at their premises, see if they are there, see if they are manufacturing, see if they really are who they said they are. That kind of information is critical because it is going to help you to make that assessment. It's going to help you to understand who your debtor is and where they operate from. Another thing that you need to understand about your debtor before you engage. If you're selling a product to them, which they are going to utilize in a contract or in a function, and that product is utilized, and if they don't perform there, they will not get paid, and therefore they might not be able to pay you. You need to understand that, and you need to understand what the risk is around that. Do you have such a client? Do you? Especially when it comes to contractual businesses. In the building industry, it is a huge risk. I supply bricks to the company, they take my bricks, they build a house. They do a sloppy job, the owner of the house, the contractor, the main contractor doesn't pay them, they don't have money to pay me. Problems. And so it goes on. There is various others. If you have a reservation of ownership, it means the product belongs to you, but if the product's already been used, what can you do about that? Nothing. Make sure that you engage with the client in a secured manner with that. So you understand what your debtor is going to do with your product. You understand where your debtor is. You understand how long they've been in business. Now you order that bureau report from your information provider. Certain of that information is very critical and can be very helpful. Now, I just said to you, you must establish what do you see as information being in date and what do you see as information being out of date. Let's ignore that for 1 minute. I've got a credit application. I've got a bureau report. The bureau report, apart from the statutory information from Sub-C, is 2 years old. So, do I now call immediately for an update report before I can start engaging with my client? Or do I want to give him some sort of credit? Do I want to start engaging with him a little bit? I got to make a decision. I can immediately, although this report is 2 years old, establish something. On my credit application, they've given me an address, 2-year-old report, same address. They've been there for 2 years. Same auditors, been with the same auditors for 2 years. Same bankers, been there for 2 years. Same directors, been there for 2 years. What am I establishing? Stability. Immediately, I already know that this business is stable. Now, right now, I just said to you, and that's why I first spoke about adverse information, because it cannot be up to date. It might not be up to date. It might not be in date because of the backlog that we have. But if in a normal state there was no adverse information, it also means that this company is trading fairly well. So now you don't have an update bank report, you don't have trade references, you don't know this, but yet you've already seen stability. Also, they've given you the exact same trade references that you already have on this old report. Now, I will not tell you to phone someone for a trade reference if I know I haven't paid them. That would be very stupid of me, because you're going to phone them and they're going to say, Martin Pets Pty Limited doesn't pay us according to terms. They don't pay us the full amount. They pay us late. They have always got queries which are invalid. And all of these things are going to come out the woodwork. So I will give you my nice ones. So if the trade references are not the same as the previous ones, then there is a little bit of a problem. If it is a prominent company that only sells a very certain product, and I mean, I can see some of you, and I don't know all the products that you are involved in, but you can see if your opposition is there, and if your opposition is not one of those trade references, my question is always why? I will then go as far as phoning that, or asking the bureau that you utilize to phone the opposition and say, do you deal with Martin Pets Pty Limited? Because then you might just get a very true picture about what really is going on and why Martin is not buying from them, because his account might have been closed by then. But that's additional information. I'm now just looking at this old report. So now I've established stability already on a 2-year-old out-of-date report. So certain of that information in an outdated report is still extremely valuable and extremely informative to me. So if this business has been in business already for 20 years, I don't immediately know if they've been at the same premises for 20 years, but I at least know that they've been at the same premises for 2 years and the same directors, but I can see how long the directors have been there. And if those directors have been with that business for a very long time, it also tells me about a lot of stability, because it tells you the date that those directors joined. And also you can look, when you look at those directors' information, and remember, this is still an outdated report that I'm looking at, and you look at the directors' information and you see some of those directors are involved in a lot of other businesses. It might be that they are an investment director. In other words, they are representing someone else, or they themselves are part of an investment group that invest in businesses, and they serve as directors on these companies because they want to look after their own investment. So you must always look at their other directorships. So if you see investment companies under their other directorships, you can immediately start linking these things to one another and say, aha, okay. So Capital Invest, Martin is a director of Capital Invest. Martin is also a director of Inoxico. That means Martin Petzer is looking after Capital Invest's investment in Inoxico. That's a very good possibility, because when you look at the shareholding of Inoxico, you find Capital Invest there, and you see that they're a shareholder, and you know, aha. So now you start linking these things, and it's all on outdated information. Outdated on the rest of the information. Your statutory information is always up to date. Always up to date. So now you can understand, and you can start putting the puzzle together, and you can even start engaging and giving your debtor a small credit limit, waiting for the rest of the information to be updated to ensure that you can deal with him to the credit limit that he's applied for. And remember, you can't just give him a credit limit. They must apply for it by law. And you can't increase a credit limit, because that is governed by the National Credit Act, that they need to apply for it. Now, I don't know of a case that has been tested yet, but if you supply them over the credit limit, they can come and say, I didn't want the stuff. I didn't know I went over my credit limit. Company A, Martin Pets Pty Limited, never came to me and said to me, you are over trading over your credit limit. Remember, your credit controllers should always manage the client in relation to the credit limit. Don't tell me you don't have a credit limit for a debtor. You will run into problems. Make sure that you abide to that rule. And make sure your credit control understands that. Make sure your sales team understand that. Make sure they understand the consequence if a debtor goes over the credit limit. Either increase the credit limit with the client's consent, or if the client says, no, I don't want to increase my credit limit, okay, I understand, Mr. Client, but then you need to pay me X amount of money to bring your account back in line with the accepted credit limit. And sometimes even below that if you want more product. So understand the rules and regulations around managing that risk. So now you've looked at an old report and you've established a certain amount of risk that there is or may not be. Now, there is certain things that statutory information tells you. It tells you that your client is either in business or they're not in business. And if they're not in business, what state are they in? And what is the risk attached to that? Let's use the first and easiest one of them all. Let's say they're busy converting. They're busy converting from a CC to a Pty Limited. And they've now sent you an application still in the name of the CC. What do? I can tell you what's going to happen because I've been there. They're going to open the account in CC. You're going to deliver product. You're going to invoice them in the name of the CC. At the end of the month or 2 months later, when they're supposed to pay you, they're going to come to you and say, oh, sorry, we are now Pty Limited. Please credit all your invoices and re-invoice me in the Pty. How do you engage with them? Stop, don't engage, ask them which name you should invoice them in. Is it the new name? Is it the old name? If they say no, invoice me in the old name, say, okay, give it to me in writing that you will pay me all my invoices that I issue to you in the CC until such a time as the Pty is registered, and I then start invoicing you in the Pty. Now, by law, it's not required to actually fill in a new credit application once they've converted into a Pty. My advice to you, get a new application in any case. You never know when you get to court what that judge's state of mind is. He might not have had a very happy day the previous day or a happy evening sleeping. And he might just say, your contract is with a different business. Please always make sure that your administration is in line with the debtor that you're going to deal with or are busy dealing with. Review it on a regular basis. If you get a remittance advice or a payment, and I'm just talking about these things now because it's all risk related, that has got a different name on than the client that you deal with, immediately ask, what is going on here? Why am I getting a remittance advice in this name? Have you changed name? Have you been bought out? Have you been taken over by someone else? What is going on? If the bank account name is a different business as well, it's a major concern to me. If it says there that this bank account is in this name, but you are going to deal with this debtor, there's a problem. There's something going on there. Make sure that all this information correlates with one another. All right, so back to my out-of-date report. I now have seen first business status, they're busy with conversion. Second out of business status might be AR deregistration process or AR final deregistration. That has got nothing to do with normal deregistration. That is Sub-C telling the debtor, your new debtor, that he didn't do his annual return to Sub-C and they are busy deregistering him. So you are going to be very shortly engaging with a debtor that is not registered. So your invoice is going to be illegal. Your contract is not going to be illegal. The business doesn't exist. Immediately establish from your new proposed debtor where they are in the state of fixing this. And they would be able to supply you with documentation accordingly. Because Sub-C might not be up to date either, because they might not have captured that information in their system, and your bureau might not have that information yet. According to the bureau, according to the information that they received from Sub-C this morning, your debtor is still in a deregistration process, already finally deregistered. Risk for you. I am not even going to tell you about what happens if they are in business rescue or in provisional liquidation or in liquidation or voluntary liquidation, because that, to me, you should not even engage. Why I'm telling you about these others is your salespeople might want to open the account and you can say to them, this is the risk that we're sitting with. Understand the risk. What is the risk if a company is busy deregistering? Why would they be deregistering? They could be deregistering because they no longer want to be a Pty Limited. They want to go back to a sole proprietorship, or they have engaged in a partnership with someone else and they don't want to be known as a PTY, they want to be a partner. Or it could be that a huge group have bought them and the company's name might be a very valuable trade style, and therefore they don't want to lose that equity in the market. So they say, all right, we are just going to make you a division of us, deregister the PTY, so you're just going to trade as Inoxico Pty Limited, trading as Martin Petzer, because they like the name Martin Petzer. It's well known in the marketplace. So that could be the deregistration. Or they deregistered because they're no longer doing business. Establish that very quickly before you approve an account. If your credit bureau tells you your debtor is in a deregistration process or has been deregistered. Why have they been deregistered? They tell you something and there's something else in the background. All right, so that's all information that you have now received, that you can already assess your risk on a report that is not even in date or updated. What is an in-date report and what is not an in-date report? That you've determined, and it's documented in your credit application. So now you see this report is out of date. What do? You order a new report? Yes. You order new information? Yes. Depending on the value of your applicant's credit limit that he wants. That would also be determined in your credit policy as to what information you're going to need. If it is that it is 100,000 or 200,000, and you say, when you apply for something like that, what we want to have is we want to have a credit bureau report which contains trade references, adverse information if there is anything, a bank code, and I am warning you, the banks are talking about stepping away from bank codes completely. So we got to look at how we assess our risk differently. It's coming. Bank codes and whatever information there is. If the value goes above that, do you want balance sheet information? Do you want bank statement information so that you can actually see what's going in and out? I mean, a bank code C. To me, that's the biggest cop-out I've ever seen in my life. It means see for yourself. It means that we can see that there's money coming in and money going out to the value that you're looking for. How did you determine what that value would be? Let's, for instance, say that the client applies for 50,000 on a 30-day account. He's going to owe you 100,000 if it's 50,000 per month. 100,000 before he pays his first payment. So his credit limit should actually be 100,000. So you must be very clear as to what the credit limit needs to be. Is it the total value outstanding or is it the monthly purchases? And you got to make sure that you accurately record it according to what the activity is going to be. And then how much value is going to be outstanding. So take it 2.5 times, apply for a bank code on that value, or assess your risk at that value. So when you look at the bank statements and you see there's a risk attached, see what goes in and out of that account, when it's going in and out of that account, and what the values are. We have already, as Inoxico, gone that route. So if there is certain banks that don't supply bank codes, we ask permission from our clients to ask the debtor for bank statements. We then analyze those bank statements and we give you that kind of information. But that's not why I'm here. I'm telling you about your risk. So now you've got this bureau report and now you start risk assessing. First thing you do is validate all the data. Check the information in the bureau report, check the information on the credit application. If anything differs, immediately speak to your bureau first. Say, we see that you say Martin Petzer is a director of this business. On this credit application, we do not see him as a director. Has he been removed? Is he new? What's going on here? Let them validate that information for you. If you see a very large judgment against your debtor, ensure and speak to your debtor and say, we have just been advised that there is a very large judgment taken against you. If it's from SARS, it is very concerning. Why? Because SARS will not just take a judgment. They always take judgment if you don't pay them. But a large judgment from SARS means there is some serious money outstanding. And it could be because people will always make sure they pay SARS. First creditor they pay, PAYE, VAT. Because if they don't, it is going to happen like this, that the judgment's going to be there. And that's going to be negative against them. So if they've got a judgment against SARS, there is some cash flow issues there. There is a red light going on for you immediately. If it's a small amount, I still question it, because SARS always takes judgments, but it could mean that you have short paid your VAT or short paid your PAYE, and they are unhappy with that situation and they've taken judgment against you. So just establish what the rationale or the reasoning behind that is. If it is a huge client like a ShopRite, Checkers, or a Pick n Pay, or whatever company we can talk about, I hope there's no one of them on this line, but judgments, they've got lots of judgments against them because people are unhappy with something and they go and take the judgment. Whether it's valid or not valid, they just take the judgment, and it cannot and might not always be relevant to risk. Understand who's the debtor, what is this adverse information that you've just seen or have just been notified of. So look at that. If a director has certain negative information against him, understand what the business does, who the business is, and what his level of involvement is. If it's a public company with a director with a judgment against him, he's got nothing to do with the company's risk. Nothing. He's a person that serves a purpose. Unless he is the majority shareholder, that he holds 90% shares of this public company and he is fraught, then there might be a risk. Otherwise, there's no risk. If it's one director in a business and he's got multiple judgments in his personal capacity, that is a risk. That is where I start getting concerned about it. That is where I start asking questions. If you open these directorships, that he's got multiple businesses that he's a director of, and all of them have got a negative business status against them, either been liquidated, been sequestrated, been provisionally liquidated, in business rescue, or are in AR deregistration or AR final deregistration, it tells me that this guy's admin processes isn't working, or that he is going to take you for a ride if he's got a lot of companies that he's liquidated before. There's a risk attached to it. Judgments against one director in a business, if he's the only director, he might start taking money out of that business to start supporting this risk that he has on the side here. So those are the kind of things that you look for in your bureau report relating to your credit application. Risks that are not spelled out to you. Another risk that is not spelled out to you is when you start looking and you see this business is there, and you see that these guys have got multiple businesses, and the property that they are trading from is also owned by them. Why am I warning you against that? Have you heard of the Landlord's Empathy Act? Yes, you have. No, you haven't. Let me tell you quickly what it is. It means that if you don't pay your rent, the landlord comes and he takes goods to the value of his rent, and he sells it to recover his rent. Now, if I am the landlord and I am the business that is trading there, and I do that, I take your stock away, I open another business and I sell your stock in the other business. And you can do nothing about it unless you have a reservation of ownership. And if you do have a reservation of ownership, you need to advise the landlord of that reservation of ownership and say, you cannot touch my product. It belongs to me until this debtor has paid it. But be aware of this kind of thing. Or if you see similar businesses than this one that you are now going to engage with, that these guys were involved in before and they've been liquidated. Recently, I saw a business, they are in fire control. And in this instance, it was the reverse. They were going to supply services. They were a vendor of this client of ours. And they had a few businesses like this before who all went into liquidation. Now these guys come and say, oh, you got to pay us a deposit. Now you pay him a deposit. Now he doesn't render the service and he goes into liquidation. Boom, you're out of business. Ensure that you understand what risks these guys had in the past and if that risk could have any influence on your new risk. So look into all of this of your directors, where they are, where they've been, what they do, and what they're involved with. If you are a business that does business with American companies, Sarbanes-Oxley is lurking in the side there. And if there's any businesses that is in the sanction list, make sure you understand that, because that could also be a risk to you and could be problematic to you. Now, we've got a credit policy that gives us certain guidelines. We've got a credit application and a service level agreement that gives us rules and regulations. And we've now got all of this information, and we've got all of this together with a new bureau report with all the information. There's nothing negative on it. Make sure that everything always stays together in one space when you start approving the risk. So once you've signed it off and it's gone through all the levels of authorization and the right people have signed it off and their credit's approved, you advise your debtor that he can now start dealing with him. If it is that you're giving him a smaller limit because you've only got old report and you've assessed that there's stability and you want to engage with him a little bit, tell him that you are still in the process of assessing the risk. However, because of the stability seen in his business, you want to grant him a credit limit of 10,000, 12,000, 15,000 so that they can start engaging with you. And this is immediately building trust with your debtor. So the more you stay in touch with your debtor, the better you understand your debtor and the easier it is to control your risk. Right now, in the situation that we are, risk is great because people are working from home. And you don't always have the accountability in the offices anymore, but they will still be there. If it's a service rendering business, it becomes a little bit more difficult. But if it's a product-related business, you can always go and engage and see if your product is there, if the business is still working. There's Google Maps, there's videos, there's cameras. You can drive past them. You don't necessarily have to go there. And you can go look through the window and see if they're still there and if activity is still happening there. And if you see someone else's product there, you can phone them and say, listen, I also deal with Martin Petzer Pty Limited. How are they paying you? If they say, no, I'm not going to tell you. Okay, then phone the next one. Somewhere along the line, someone will tell you. Networking is critical in today's business world. Understand your opposition and understand who they are and talk to them if you can. All right, now you get the new report and you assess the risk. Anything that looks out of place for you, make sure you understand why it's looking out of place for you. Ask questions. If it's not to the bureau that you're dealing with, it is to the debtor that you're dealing with. But someone needs to answer that question in full and give you information. Securities. If you see on a bureau report that the guys have given away everything as security to someone else, know that you are a concurrent creditor, and if there's anything going to go wrong in this debtor's world, you are not going to recover anything. Understand that up front. Don't let it be a surprise to you. All right. Okay, so you understand your credit policy, you understand your credit application, your credit bureau document speaks to all of this. Everything ticks the boxes, everything is correct. Everything is okay. There's no adverse information. Your bank code for now is still there. It's still okay. The directors are clean and have no negativity against them. If they have, start questioning this. Ask questions. Ask if it's been sorted out, especially on the ARD registration and the deregistration process. Know what's going on in your debtors world. Then you make your risk assessment. Monitor your risk closely. And the closer you are to your debtor, the better your risk will be for you. Okay. So now I've crammed a lot of information into a very short period of time. I'm going to put it open to questioning for you. If there's anybody with a question, please raise your hand. I'm talking about your electronic hand because I can't see you. And then I can answer the question, or we can ask the question openly and we can answer it for you. If you don't want to do that, I'm going to share my cell phone number with you, and you are more than welcome to speak to me afterwards. Or if you want to set up a separate meeting with me, either via Fatima or directly with me, so that we can assist you in helping you managing, mitigating your risk from your credit policy to engaging with your debtor. Any questions? Okay. Everybody seems to be looking happy, or then, oh, there's a question. Barrows.
Hi. In a practical credit application time with nobody disagreeing with any of the terms or with any of the points on your credit application.
I can't hear you very clearly. Can you either just speak a little closer to the microphone?
Okay. So in a perfect world, it would be wonderful if everybody just agreed to every term and condition on a credit application.
Yes.
But generally, there are many terms and conditions where they scratch out stuff. And I'm saying that because I know we do that for credit applications, that we just scratch out stuff, change the wording. How do you deal with that? Because you just the admin person, and then you've got to get your lawyer involved, and then the lawyer, there's lots of back and forth. So
well, you must validate. The easiest part, first of all, is to validate what that term is that they're busy. If it is that they don't want to pay interest and they take that out, clarify that with the people that has the authority to say yes or no. So in other words, if you're a credit controller, escalate it immediately to your credit manager or to the group credit executive or to the FM or to the financial director and say, are we allowed to accept this client's specific request not to pay interest on an overdue account very quickly. If it is that they're changing the terms of business, where you're now saying that you've got to get your lawyers involved, that to me always spells a bit of a problem to me. What is it that they're not agreeing with? You have to evaluate that. It is complicated. I know, because I don't understand always what your business terms and conditions are. I'm talking about the business terms and conditions. I'm not talking about general terms and conditions. General terms and conditions are jurisdiction and interest and terms and things like that. If they don't agree with your terms, once again, you've got to ask yourself, is there enough margin to give them 45 days or 60-day terms? If your margin is 5%, how much of your margin is going to be eaten up by the time they've paid you? Because you must remember, you're paying interest on money that you've taken from your bank to manufacture your product to give to him, and now that product is outstanding there and you're paying interest to your bank. Those kind of things must be taken into consideration before you agree to something to change a specific term or condition. However, when it gets complicated about specific okay, I don't take accountability for a product that has been damaged in transport and things like that. Those are very specifics. I can't give you that answer right now. But it would be good for you and I to engage and say, this is my term or this is my condition that I frequently get requests to withdraw or to take out or to draw a line through. Then you need to relook at that term maybe in totality and adjust your terms and conditions because of that specific term. But it is necessary to understand why clients draw a line through a specific term. The normal ones are usually jurisdiction, interest charges, terms, and those kind of things. Those are the normal ones that they usually draw a line through. Or personal surety, if that is a term in your terms and conditions, they draw a line through that. They say, we're not interested in that. Be assured you know the implications on your business if you accept a term being drawn a line through.
Thank you.
Okay. Any other questions? Just take your hand down, Burrows. Otherwise, I thank you. Any other questions? Guys, you're more than welcome. My cell phone number is 082 575 3568. Fatima is going to share this video with you in any case, and she will put my contact details on there and share it with you. If you have any questions, you are more than welcome to speak to me, and we will assist you in any which way we can. Thank you very much for being such good listeners. Have a fantastic day and enjoy your weekend that is coming after the day tomorrow.